Alphabet reported the highly anticipated quarterly financial results after the stock markets closed on July 23rd, 2025. In this video, I'm going to review the big picture takeaways from that quarterly earnings release. I'm going to reveal some things that you're probably not going to see with mainstream media, which just takes the headline figures of revenue and earnings per share without any real financial analysis. I'm actually going to dig deep here and reveal some financial analysis and what it could mean for Alphabet stock investors. Of course, I've had this stock rated as one of the best stocks to buy this year. I've owned Alphabet stock since 2020, and I've had Alphabet stock rated as one of the best stocks to buy for a couple of years now. So I've been bullish on this company. But am I still bullish? Do I still think the stock is a buy after what the company reported in these quarterly results? I'll share those details with you here. I'll share with you my updated proprietary discounted cash flow valuation model, which I updated following the company's earnings release to incorporate many big changes, including an extra $10 billion in debt, a lower share count, and higher capital expenditures, including an increase in my forecasted growth rate for the company in the short term and its medium term expectations.
I want to thank The Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
So right off the bat, Alphabet talked about its biggest risk, which is search. Search engine declines in the search engine business are the biggest risk to Alphabet stock investors. This is the thing I've been talking about most over the last few years as a bullish investor in Alphabet stock. I'm watching this as an owner of Alphabet stock. I'm paying close attention to see what's going on in this segment because this segment is under threat with large language models. And thankfully, another quarter of solid growth here as the company said search delivered double-digit revenue growth and new features like AI overviews and AI mode are performing well. That's great to hear, right? Because all you've been listening to and hearing about with Alphabet is how large language models are going to kill its search engine business. And while that risk remains, it keeps getting pushed further and further out. The company also said that cloud revenue increased excellently with backlog and profitability increasing. And as a result of that better than expected performance for cloud, they're increasing their investment in capital expenditures in 2025 to approximately $85 billion and are excited about the opportunity ahead. This was great news. I was not expecting this. Some investors took this to be bad news, and I can understand why investors are fearful of a company increasing their investments in capital expenditures. But I don't think you should be concerned with Alphabet increasing its capital expenditures because they've historically been an excellent capital allocator over previous 2 decades. So you can be reasonably confident that if the management team is increasing their capital expenditure plans, that they see a great opportunity to generate a good return on that investment. So I was actually happy to see this as a shareholder myself. I would wish that they just keep increasing this number because if they're investing $100 billion and their return on investor capital is roughly 30%, that means an increase in about $30 billion of annual profitability as a result of that $100 billion in capital expenditure investment. Now, that's a simplified example, but it just goes to highlight that the company generates strong returns on invested capital. And so the more capital they invest, the more as an investor, you can expect the company to generate profit expansion. So in the quarter which ended June 30th, the company reported 14% revenue growth, which is the same revenue growth in the same quarter last year. That's solid, up to $96.4 billion. Operating income jumped to $31.3 billion, and the operating profit margin remained at a very healthy 32% margin. As I mentioned, I'm watching closely to Google Search, and you can see another quarter of expansion in this category. Google Search revenues jumped from $48.5 billion up to $54.2 billion. So while the threat from large language models remain, so far, Alphabet has done an excellent job keeping that threat at a distance while growing this very lucrative segment of its business. Google Cloud has grown to become a $50 billion annual run rate business, and in the most recent quarter, it increased to 13.6 billion, up from 10.3 billion. One note of concern is the number of employees. While I'm okay with Alphabet and their capital expenditures, I'm a little bit concerned with the company's employee growth. That's a category where historically they've been a little bit loosey-goosey, hiring too many people, paying them too much, offering too many perks. And we saw that in 2022. Remember, at the end of 22 and early 2023, when they had to do a massive layoff and they had to pay billions of dollars in severance packages. And we saw just how bloated their employee count had gotten. And now they're increasing their employee count again to 187,000, up from 179,000. This was the one area I was not happy to see expansion in for Alphabet. So let's take a look at the balance sheet and understand why I like when the company invests into their data centers optimized for AI. You can see as of December 31st, 2024, Alphabet had a whopping $95.6 billion in cash and equivalents and marketable securities. So this is $95 billion that the company is earning like 4 or maybe at best 5% return, right? 4 or 5% return. When historically, Alphabet on capital that invests generates roughly 30% ROIC. So would you rather have this $95 billion sitting in a savings account or short-term government bonds earning 4 or 5%? Or would you rather have Alphabet investing in categories that have historically generated an ROIC of 30% for the company? Right. So personally, I would prefer the company take this money that's sitting in bank accounts or, short-term savings accounts and allocate into these projects, especially if these projects have demonstrated a good ROIC. So I don't want them to be, wasteful and just throwing money at anything, but if they find opportunities to invest, and by all evidence that we're seeing, data centers optimized for AI is a category that looks to be very promising. Uh, all of the major cloud providers have talked about how demand exceeds supply. So we're talking AWS, Microsoft, Alphabet. They all say they could have generated more revenue in these segments if they had more capacity. So this is the kind of category you would like to see the company invest in, and that's where it's going, right? You see their property and equipment net. This means net of depreciation jumped from 171 billion up to 203 billion. So now the company has an extra $32 billion net of depreciation of more assets that it's going to generate profits on, more assets it's going to generate revenue on. So these are performing assets now that you can reasonably expect them to deliver better than a 5% ROIC, which is what they would be getting if the money was sitting in their, bank accounts or money market accounts, 4 or 5% return. Instead, they're putting it into these data centers optimized for AI where they have more demand than they have supply. Right? So it's reasonable to expect this to deliver positive ROIC in excess of what they would have had in a savings account. Still, when companies are increasing their capital expenditures, I pay closer attention to their cash flow statements. And we don't have anything to worry about with Alphabet. In the quarter that ended June 30th and in the 6 months that ended June 30th, Alphabet generated 27.7 billion and 63.9 billion respectively in cash flow from operations. So out of that 27 billion, 27.7 to be precise, they spent 22.5 billion in purchases of property and equipment. So they still had more than $5 billion left over after allocating $22 billion to their capital expenditures. And even more so when you look at the 6-month period, they generated 64 billion in cash flow from operations and they allocated 39.6 billion. So they still had roughly $24 billion left over even after spending close to $40 billion on CapEx. So the bigger issue for Alphabet stock investors is the company finding areas to invest, finding profitable areas to invest. So if they are investing in these categories, that's a big relief for Alphabet stock investors. So I was happy to see that, even though I think some investors and some headlines were suggesting that this was bad news. For me, it's not. With companies like Alphabet, like Amazon, like Netflix, that have just demonstrated incredible skill in managing capital, I like to see them do more. Like if I'm a Netflix stock investor, I tell them make as much content as you can possibly make. Any idea you have that you think is a good idea, run with it, please. You deserve that runway because you've demonstrated a great ability, a great skill in this regard. So I just want you to do more of what you're really good at. And I'm the same with Alphabet, right? Building data centers is something they're really good at. I want to see them do more of what they're good at. And that's what they did here in the most recent quarter, in the most recent year, and in the most recent 2 years. So Alphabet stock is now trading at a forward price to earnings of 20. And I'm getting this data from fiscal.ai, which is my preferred data source. There's a link in the description for a discount. At a forward PE of 20, I still think Alphabet stock is relatively cheap, relatively undervalued. And I think what's incorporated in this valuation is that risk from AI. That's why the stock is trading at this relatively low valuation. Now, I updated my proprietary discounted cash flow valuation model for Alphabet stock, and I increased the intrinsic value per share as a result of a few factors. Number one, I increased my expectations for growth for Alphabet over the next 5 and 10 year periods. Not by that much, but by 2 percentage points and 1 percentage point for the short term and medium term, respectfully. And the reason why I increased my expectations of growth for Alphabet for those next few years is because of the capital expenditures, the assets that they're spending money on. I expect a return on investor capital on those assets because the company has demonstrated an ability to do that. Also, the company added roughly $13 billion in debt, and that was a positive for the valuation because if you look at my weighted average cost of capital for the company, the cost of equity is at 10.4%, whereas the cost of debt is just 6%. So the more money that Alphabet borrows, the more of its capital is sourced from debt, which is at roughly half the cost of its equity. And so it lowers the company's weighted average cost of capital. Now, it can't do this infinitely, right? But since it only has $23 billion in debt and a very strong balance sheet, it can continue to do this for several years. It can continue adding tens of billions of dollars in debt and lowering its weighted average cost of capital because the balance sheet is so strong and so heavily weighted towards equity. So over the next few years, it can lower its weighted average cost of capital by, I think, a couple of percentage points by adding more debt, low cost debt, because Alphabet can borrow at very low interest rates because it's such a strong company, strong free cash flow, strong balance sheet. And then, of course, since they're buying back so many shares, I reduced the number of shares outstanding to incorporate the latest update from Alphabet. And so with lower shares outstanding, the free cash flow this business is expected to generate between now and the very long run is split among fewer shares. And so the intrinsic value per share increased as a result of all those factors up to $231 a share. The current market price is $190. So I see undervaluation both in terms of my proprietary discounted cash flow model and also when I go to fiscal AI, the forward PE, they both point to an undervaluation, which led me to reiterate my recommendation on July 23rd of Alphabet stock as one of the best 9 stocks to buy right now. Hey everyone, so many of you have been asking about my investing strategy, and I'm excited to announce that I've written a book that's available for sale now that describes my 6-step investing framework for evaluating stocks. I've added the link in the description below.